The global currency markets are being reshaped, not just by central banks, but by missiles, alliances, and political calculations. Recent geopolitical flashpoints, particularly in the Middle East and Eastern Europe, are not isolated events. They are systemic shocks with ripple effects across every major currency pair. Iran's latest strike on Israeli infrastructure marks an escalation. Investors must interpret this not just as regional conflict, but as a global signal. The U.S. dollar, traditionally a safe haven, surged on initial reports. But strength in the dollar doesn't come without cost. With American interests stretched across multiple geopolitical fronts, prolonged engagement could push the U.S. into deeper fiscal imbalance, eventually undermining the greenback's long-term position. On the other hand, the Swiss franc and Japanese yen continue to assert themselves as risk-off currencies. When missiles fly or headlines flash red, flows instinctively move into CHF and JPY. But Japan's inflationary backdrop complicates the yen story. Forex investors must weigh short-term haven demand against long-term yield divergence, especially as the Bank of Japan begins to taper stimulus. In Europe, the euro remains vulnerable. Energy insecurity, worsened by Eastern Mediterranean instability, undercuts confidence in the eurozone. With the European Central Bank hesitating between fighting inflation and protecting fragile growth, euro to U.S. dollar is caught in a policy and security limbo. Emerging market currencies, particularly those with high oil exposure like the Mexican peso or Nigerian naira, are in flux. As oil prices climb on geopolitical fears, commodity-linked currencies may surge. But this is tactical, not strategic. Long-term, these currencies remain exposed to capital flight and dollar scarcity. Forex traders must now trade geopolitics as much as economics. War risk is now market risk. The FX landscape is bifurcating. Currencies of stability and trust versus those of volatility and geopolitical exposure. The path forward is not just about rate differentials. It's about political differentials, how government handle crisis, how alliances hold or break, and how markets price the unexpected. Smart investors should de-risk exposure to politically fragile regions, hedge against oil-driven currency swings, and monitor not just central bank statements, but troop movements, energy corridors, and diplomatic signals. Because in this world, where the next headline can trigger the next 100-pip move, geopolitics is the market. Sources: Reuters, Bloomberg, Financial Times, IMF Regional Outlooks, Stratfor Geopolitical Forecast, U.S. State Department Press Briefings, Bank of Japan, ECB, Fed Official Communications.